Today we have a very special guest. She is a CPA, the author of kids' book From Piggy Banks to Stocks, the ultimate guide for young investors.
There's a lot of misconception about what investing is. A lot of times when people think of investing, they think of it as trading. Most of us are long-term investors. We invest for 5 years, 10 years. We're investing for our retirement or like our kids' college education or maybe our first home. Just because, you hear about it on the news, it doesn't make it the right investment for you. Buying one share of ETF, you're automatically
Get ready for the next iteration of you on your path to becoming wealthy. On this show, you'll get the insider's view on wealth creation, the class none of us got taught in school, with my co-host, daughter, and beginning investor, Sophia Bosch. And now, let's get started. Welcome to the Becoming Wealthy podcast. I'm your host, Michelle Bosch, my co-host,
Sophia Bosch. And today we have a very special guest. We're joined by Maya Corbic. She is a CPA, the author of kids' book From Piggy Banks to Stocks, the ultimate guide for young investors, and the founder of Wealthy Kids Investment Club. Her work has been featured in CBS News, NBC, ABC, Fox, and more. She also has a very popular Instagram account with over 195,000 followers and inspires parents to raise financially independent kids. So with that, welcome to Becoming Wealthy. We're so excited to have you.
Thank you so much for having me. I'm really excited to be here.
Okay.
So do you want to kick off with the first question?
Yeah. So I know your area of specialty is stocks. We are a very real estate heavy family, so I personally don't know as much about stocks. So I just I have like $5,000 in savings, maybe. I don't know. But $5,000, just for this example, $5,000. And where would I want to put it in the stock market? Like, where do I even want to start with those $5,000? What would you recommend?
Yeah, so I mean, that is a fully loaded question, but we can definitely break it down. And yeah, I think that, first of all, I think investing in real estate is absolutely amazing. I don't think that there is one right way of like increasing our net worth and building our wealth. I think for listeners who are interested in real estate, I think that's absolutely amazing. Some of us have a little bit of both, and some of us just want to focus on investing in stocks and other investment products, and that's fine. You can, I think, sometimes you just have to figure out, especially when you're younger, what works best for you. Um, and they like the first thing that I really want to start, and we can like really dive into details here to help somebody who has, let's say, $5,000 or $1,000 and is very young and wants to start investing. But the first thing I want to start with is that there's a lot of misconception about what investing is. A lot of times when people think of investing, they think of it as trading. So there is actually two different kinds of investing. There is trading and then there is long-term investing. There is also some short-term investing, but let's just focus on trading and long-term investing. Most of us are long-term investors. We invest for 5 years, 10 years. We're investing for our retirement or like our kids' college education or maybe our first home. Traders, that's something completely different. That's the stuff that we see on TV, in the like those movies like the Wolf of the Wall Street. Do you see those guys like staring at like 10 computer screens the whole day, like in this high pressure environment, like trading stocks, yelling at each other, whatever. Most people who actually invest for long term, they don't do any of that. And so to become a long-term investor is actually quite easy, and it doesn't look like anything like what I described before. Essentially, as a long-term investor, you just really need to figure out a few things, invest your money, set your portfolio, and then periodically review it and literally go on and live your best life. It's that easy and simple.
Do you specialize in a specific type of company or industries? Like if we want
Do you have a
to,
preference?
like we were just like decided to a few months ago to start investing in Nvidia and in a few other technology companies only because we have been learning quite a bit about these new technologies. And in learning about them, we're like, okay, I'm having a long-term approach as well, just like you. And I'm like, I see, the progression of what this can be over the next 10,
Yeah.
15, 20 years. So it makes sense, even though I perhaps didn't buy at rock bottom when these companies originally went, public. It's still a solid, it's still a solid company. But how would you advise, somebody like Sophia, or somebody that's never invested
Yeah,
in
how
the
to
stock market,
go
how
Right.
to go about it? Do you pick a company? Do you pick an industry? Do you pick something that is happening on the news, that triggers you to start investing? How would you go about it?
Yeah, so first of all, I think it's amazing that you said, okay, you started looking into this, you started researching. And I think that's a big thing that I tell everybody. If you're going to invest into something, make sure you invest into something that you understand. Never invest into something that you don't understand. Like if you don't know what the company does, or if you don't understand like what their, main service is. Just because, you hear about it on the news, it doesn't make it the right investment for you. So the first thing that I would say everybody should do is figure out your investment risk profile.
Okay.
After like, okay, I'm a long-term investor. So great. So what is your risk profile? So you can actually go online and you can Google free risk assessment tools. A lot of brokerages have them, like Vanguard or Fidelity. And you can literally populate that with your information and you will understand, like, are you aggressive? Are you like not aggressive at all? Are you somewhere in between? And based on that, you will be building your portfolio, as well as, depending on your age and like how close you are to actually getting or pursuing your goal. And so when it comes to
But quick question, Maya. So with the risk assessment profile, what are the types of results that you could possibly get, from that profile?
yeah, so it would be like somebody can be like somebody may have high risk tolerance. We may also have somebody that has moderate risk tolerance and somebody that has low risk tolerance. So if you have high risk tolerance, like for example, I am one of those people. Majority of my portfolio would be invested in stocks of companies. And so for somebody who has very low risk tolerance, meaning that they're just afraid like they can lose all of their money, they're not comfortable with any swings in the market, they would probably pick something that's more safe. And I know, for example, just recently, a couple months ago, when there was that whole talk about tariffs and the markets just went wild, I was fine. I wasn't checking the news. I know I'm like, this doesn't concern me because this is one thing that a lot of people don't know. But one of the reasons why it's really good to be long-term investor is because it's normal for markets to go up and down, but historically the market has always recovered and it has gone higher than where it was previously. So you can even, for any listeners, like they can just pull up something like on Google, they can pull up a chart for S&P 500, which is the 500 largest US companies. Yeah. So you will see the upward trajectory, but it goes up and down, up and down, up and down. So if you're going to actually look at it day in and day out, especially when the news and media, everybody's like screaming, the sky is falling, people people panic. And then that's when they sell. Once you sell, that's when you've actually realized the loss. But you haven't realized that loss. Like, yeah, right now, not right now, but like a couple of months ago, I was technically losing money, but I didn't lose anything because I didn't sell. I was just holding strong. As a matter of fact, when the market goes low and I'm very confident in my choices and in my portfolio as is, that's when I'm buying the most because the prices are low.
A contrarian could, yeah. That's called being a contrarian in our family. Basically, you do the opposite of what the masses are doing.
Yeah.
And it applies for real estate as well.
Exactly. So you understand that from the real estate point of view, right? Like when everybody's running for the hills, you're like, man, this is a great sale. Like I need to jump on this, right? And maybe I gonna buy at the very, very bottom. Like I wish I, bought it like right at the very bottom. It depends on when the cash flow is coming in and when I can actually purchase things. But I know that I've actually made a lot of money in the last few months because of when I purchased. So I think people really need to assess like how comfortable they are with that risk. Like I have Wealthy Kids Investment Club, and it's basically for families, for parents and kids that are learning how to invest. And some of these parents in our parent group, there was one mom and she's like, can we stop pretending that the market is not tanking, that this is not happening? And I'm like, we're not pretending. That is still happening. It's the reality. But for anyone who's long-term investor, this is going to happen over and over and over again. And the longer you are in the game, the more and more you see this and you become more of a seasoned investor. So when it happens next time, you're like, yay, this is great for me because I can buy more stocks at a really cheap price.
That's amazing. Yeah. So okay, so we have our risk profile, which I think we should
Yeah.
probably Google, something when once we're done with the podcast,
Yeah.
and try to figure out what your risk profile specifically is. So we have our profile, and based on that profile, where can we find, okay, these companies fall into the category of profile that I would be most comfortable. Like, where would we go find that?
Yeah, so here's another, this is just a rule of thumb, but you don't have to follow it. So before you even look at the companies, there's this rule of thumb that so first of all, like for those of you or those listeners who don't know anything about stock market, if you're investing in stocks are typically considered risky investments. Bonds are safer. Now, they are investment products that will combine different stocks, and they're called mutual funds, but there's also something called ETFs. I absolutely love ETFs, and I encourage everybody to learn about ETFs. By the way, I do have a free guide that I can share with your audience, but we can talk about
That would be fantastic. Like,
yeah, and you can link it in the podcast notes that actually explains how to invest in ETFs in a simple way. And this is what I do with my kids. And like they're so simple that even kids can understand them. But so you can have ETFs that combine different stocks. You can have ETFs that combine different bonds. You can even have like there are ETFs that invest in real estate. So if you don't have money to invest into like bricks and mortar real estate, you can invest in these ETFs that basically
That go out and invest.
yeah. So there are
explain what does the ETF stand? What does the E, the T, and the F stand for?
so they're called exchange traded funds, ETFs.
Same.
And the beautiful thing about them is that, like, I'll give an example. One of my favorite ETFs, it's called VOO, and it represents the 500 largest US companies.
Okay.
And so the way it works is it basically represents all the companies that are listed on the S&P 500 stock exchange. So
Okay.
in order for a company to make it to the S&P 500 stock exchange, there are certain criteria. They have to be a really solid company. And so this ETF automatically follows this S&P 500 index. So by buying one share of ETF, you're automatically investing in 500 largest US companies. And NVIDIA is one of them. Meta, which is Facebook, Google, Amazon, Johnson and Johnson, like all these companies are part of that. So you're diversifying your risk. You're not putting all your eggs in one basket.
In one stock. Now, what is the minimum investment to basically invest in one unit of this ETF?
Yeah. So VOO is a fairly expensive ETF. And so I'm in Canada, but in Canada, it's about $540 Canadian. I think US is probably 400, maybe 400 US dollars. Don't quote me on it. I mean, also the date when you publish this podcast, I think it might be different, right? But one thing that people can do is they can buy fractional shares of ETFs. So a lot of brokerages allow that. So if you only have $100 and that's all you can afford, you can actually use that $100 and buy a fraction of a share. Another thing that's very similar to ETFs is something called index funds. And index funds, they work essentially the same way as ETFs. So when you purchase with index funds, you're also purchasing all, let's say, 500 companies of VOO. It's not called VOO. It would be called something different. But the way it works is that if you only have $100, that's what you're purchasing. So it's very different as to how you're purchasing, as well as when your order gets executed. And I like to compare it to like when you go to a bulk store, right? Where you can buy, let's say, gummy bears. Let's say you have $100. You can buy whatever you can buy for that $100 in terms of gummy bears. But if you go to a supermarket, the gummy bears are already packaged for you. So how many of those packages of gummy bears can you buy? So the packages are ETFs. The bulk bar or the bulk food store is index fund. If that makes any sense.
Yeah, yeah, absolutely. We get it. Now, you talked about brokerages, which is a little bit different than when we talk about, brokerage in the real estate world. But in real estate, like Sophia has already done a land flip, she had to actually pay closing costs to a title company in order for them to basically prepare all the documentation of the closing with the seller, with the buyer. And can you explain what are some of the fees that you basically can anticipate when you are investing in the stock market, and perhaps a little bit of a guidelines as to brokerage setup, because we you need an account to begin with. So I'll pass it on to you.
Yeah, and there are brokerages out there that charge more. Some of them charge less. So first of all, I do want to mention that with ETFs, in order for those ETFs to be managed, I want to talk about these fees first before I talk about brokerage. So ETF fees, the reason why I like them so much more than mutual funds is that their fees are very low because they typically follow the market and there's very little management involved. And because
What is the dollar amount or percentage that we can expect?
it would be like 0.023%.
Okay.
If you are paying, let's say, if you invest into a mutual fund, which is kind of similar in a way to ETF, except ETF essentially follows the market. But with the mutual fund, there's a manager that's picking and choosing what stocks and bonds are going to make up that mutual fund. You're paying for that person's expertise. And 97 or 93% of those managers are wrong all the time. They don't beat the market. So you're just better off going with an ETF where literally the ETF follows the market rather than having this person trying to beat the market.
Yeah.
And so the fees are really high. So internally within that investment product that you're purchasing. And so that's one fee that you would be paying, but that's kind of automatically deducted and you don't really worry about that. But when you open up a brokerage account, some brokerage accounts will charge you a fee to maintain that account. There would be like an annual fee. A lot of them don't. For example, I think Fidelity doesn't. Then there could potentially be a trading fee. So let's say every time you make a purchase, you buy one share of a stock or one share of ETF, there would be a fee associated with that. Again, some brokerages do not charge that. Then there could be, there could be a sales fee as well if you're selling that ETF. So when you're choosing a brokerage, it's really good to understand what it is that they would be charging you for. And usually they list their fees on their website.
Mm-hmm. Any recommendations? Any top three that you would say? Okay,
Yeah, the top three that a lot of my members have confirmed are really great because I am in Canada, but I do a lot of, actually majority of my members are US, so I do a lot of investing in US. Majority of them have mentioned Fidelity, Charles Schwab, and Vanguard. Those are the top three.
Awesome. So
just making sure, a brokerage is basically a platform or something where you can start your account to start getting
be able to purchase it.
and make your profile or like
The risk assessment?
no, create the list of stocks that you have.
Yeah, that's a really good question. So actually, a lot of people don't understand that. And it's so funny because I did a reel a couple of months ago on that. And people are like, oh, I finally get it. So think of, think of a brokerage. Let's say it's a basket, right? It's a company, but it's a basket that's going to hold your investments, but it doesn't hold your investments directly. So you open up a brokerage account, but within that account or within that basket, you can open up more accounts, or you can put in more containers inside of that. Each one of those containers will represent a different type of account that you open. So for you, Sophia, it could be custodial Roth IRA where you can contribute your income.
Okay.
Sometimes, it could be like UTMA. And when you get older, it could be your regular Roth IRA. And so you can open a lot of different accounts. Once you open up those accounts, then within each one of those, you actually have to transfer the money from your bank. And with that money, you would be buying investment products like ETFs, index funds, stocks, bonds, etc.
Okay. And that would go into those different buckets and to those different.
Yeah, so within each of those, and then so within each of those accounts, like you would basically have your portfolio, and so your portfolio would be, it's a fancy word. It's just basically a collection of the investment products that you purchase, and the investment products that you would be purchasing based on your risk profile. So you may have some stock ETFs, some bond ETFs, or just regular stocks if you just want to focus on investing in specific companies. But I find that it's just so much more easier to invest in ETFs rather than individual companies because you really have to be educated on the companies that you're investing in.
Absolutely. Now, what returns can like we expect? Like if she was to put, some money into an ETF like the one that you mentioned, like the VOO, and she put, I don't know, $1,000 of her $5,000 in savings. What kind of growth can she expect over the next 5, 10 years? Like, what is it? What is a typical return?
Yes. So the average rate of return for VOO has been about 10%.
Okay.
And some years it's been significantly more. Some years it hasn't. But I would say, like, if you were to actually look at, I wish I had a chart to share with everybody, but most years it has actually performed significantly well, especially the last like 20 years, it actually overperformed rather than underperformed. And I think only there were a couple of years maybe where people lost money during those years. But if you're a long term investor, you're holding for long term, so you make that up anyway.
hmm Now, how do you, I know you have an investment club with parents. Like, how do you help the parents teach the kids, long term thinking in a world where there's instant gratification? Like, I want to know something, like in an instant, you do a search.
Or for little kids, like
I want a lollipop. I want it now. If they were, if they're of a certain age, but so how do you start teaching this, long term vision? Because that's really what it's about.
Yeah, so it's really important to tie, and I teach parents not just about investing, also teach them to help their kids learn about money. But number one thing that we can do for our kids is actually tie the long-term gratification to their goals. Like,
Yeah.
and whatever those goals may be, and when you tell your kids, "Oh, we're saving for your retirement," it's like, what? They don't care. Or we're saving for your college education. Some of them really don't care.
Which now it's Sophia that is a junior, and so she's a rising senior. She'll start senior year this fall. So now the conversation of college fees, she's actually gotten a little bit of sticker shock, I think,
oh my
to look
god,
at some of the fields that she's
so
interested
exciting.
in the tuition fees. So it's becoming much more real for her, you know. And at this point, you have about a year to keep on adding to your little nest egg,
Yes.
towards college. But then after that, quite literally in 5 years from now, so in a 5 year time frame, you're probably going to be coming out of college. And then the next big thing that I would think is like, okay, I get a job somewhere. Where am I going to live? If I am I going to be a renter, or am I going to buy and perhaps a home purchase and saving towards, or investing to have that money to buy a home might be the next logical big expense to or goal, like Maya was saying, to think about,
I
as
have
you're
to.
going through. But yeah, but I know that I interrupted Maya there, but I wanted to bring it like real for her because
Yeah, because I've been looking at that because there's always I'm trying to get out of state. I don't know if I can be in Arizona.
she wants to get out of
I
state.
want to I want to change, but I do know the cost of like a college the out of state tuition is wild. Um but then it's like I see that and I really want to go there, but I see the cost, and then but then I also have ASU here that I could probably get like merit scholarships or like in-state tuition, all of that. I could basically be covered. So which one do I would rather like? I have to start thinking about that. It's also
Yeah, like my son, he is I mean, we're in Canada, it's similar process, but he is just graduating high school and he accepted essentially equivalent to your like in-state college. And we live in Toronto and he will be commuting because it's quite close. So it was like, do I stay on res or but then we ran the costs and he said to me, Mom, I would rather, have a car for now, like a used car, and that money because we have like we've been saving for him and like something similar to 529 plan for as long as he's been born. And on top of that, any money that he got for Christmases or special occasions like birthdays and whatnot, we've invested all that. So he has this other nest egg. And I'm like, I really don't want to touch that. And I was telling him, I'm like, when you graduate from university or college or whatever, you can literally have enough money for down payment on a nice condo or house. So I said, it's up to you. Like, this is your money. And literally, like, now that we've come to that point where, okay, now we have to decide what to do with that money, he's like, I think I'm going to stay at home. He's like, I'm going to network as much as I can. He's like, I'm going to join the clubs because, he wants to be part of the activities that are happening there. But he's like, I really, considering that so many young people will not be able to afford their own homes, he's like, I know actually if I continue investing, I'm going to have enough for down payment. And he's like, I can actually afford something. And then maybe, rent out a part of the home and
yeah.
like help cover cover the mortgage that way down the road. So we are talking about those things. And I think everybody needs to decide for themselves, but I like to inspire my kids. Also, another thing, because you asked me how to inspire kids, you can go online and you can search up free compound interest calculator. And there's a lot of different ones. You can choose the one that you like the best. But what I like to do is I like to put in the amount of money that, let's say, they currently have in their investment or savings account. And then how much more if they add, let's say, $50 a month or $100 a month now until like, I don't know, 2030, what's that going to grow to? And I find that really inspires them because they can see how much money is.
it makes it real. Yeah. Yeah, absolutely. That's a good
I know Papa has done that.
with you as well. Yeah. Now, is there a difference do you
Oh.
notice any difference between
Oh yeah. I just had a curiosity. I don't know what age range you typically have like with the parents and the children. I'm guessing like fairly larger. I don't know.
like what is the average of age of the kids that are inside of, that you're working with the parents for inside of the investment club?
Yeah, so in the club, we literally have parents that have infants and parents that have teenagers, or like even parents that have 20-year-olds. We even have some grandmothers who want to teach their grandkids. But a lot of times it really starts with the parents. The parent has to educate themselves, and then they pass on that knowledge onto the kids. But we also have, things for the kids as well. I originally started this company 13 years ago because I used to go to schools before COVID and I would teach all the way from kindergarten till like the end of high school, like up until kids being 18 years of age. And so, you had to teach it differently in an age appropriate manner. But all kids are very curious about money and they want to learn and they're fully capable of learning all that stuff.
I and within that, is there a difference? It might be depending on the age group or the parents, how they teach it, whatever. Do you see a difference between like girls versus boys comprehending the different concepts, investing concepts?
So sadly, I have to say yes. Yeah. And we're three women here on this call. And I don't know if it's what it is, but boys are just naturally more curious about making money and especially about investing. They are so into it, and girls, not so much. I actually had maybe some 10 years ago, I was actually there are a lot of public schools here in Toronto, and I was actually scheduled to do some workshops in one of the schools, and it's a public school. It had co-ed classrooms, and they were running this pilot project where they separated. I believe it was grade twos. Yeah, I think it was grade twos. They had a lot of different grade twos, different classrooms of grade twos, and it was co-ed, but they separated this one cohort into girls and boys. And so I went to teach them, and this was kind of like, as a woman, I'm like, man, I can't believe this actually happened, but it really did. So I went to teach the girls, and they're like, oh, we love your hair. We love your makeup. You look so pretty. Like, we exchanged all these pleasantries for the first 10 minutes. And then, I taught them my like curriculum for grade twos. In grade two, I now actually can teach, now I teach investing even to grade twos. But back then, because I was first starting out, I wasn't teaching investing to grade twos. And like it just ended, with basic lessons or about money and whatnot. Then I went to the boys' class. It was business right from the start. They're like, "So, are you here to teach us investing?" And I'm like, "No, no." I'm like, we're gonna learn other things. I don't teach kids investing. Kids your age, and they're like, "Why? We want to learn investing." So I literally changed the lesson right on the spot and started teaching them investing because all they wanted to know is how to invest their money because they somehow knew that you can't just save your money to wealth, like you really have to invest it. And they were
Yeah.
very curious.
Yeah, maybe it's a little bit more assertiveness, perhaps a little bit more self-confidence in general. Or yeah, because I would think that it would have to do with how you are, what you're playing with, or what kind of play you're engaging in, and perhaps that triggers.
And you also don't know like what the parents were doing or whatever.
Exactly. So, yeah, has the type of household that they've grown up um made a difference in the boys that you have taught some investing to?
Maybe. I mean, I just went to that school. I'm not sure what the households they came from, but I can tell you, and that was some 10 years ago. And I really hope I feel like financial literacy education has really changed significantly. And, we as a society globally, we have changed, right? I mean, women are being empowered more and more to make certain, like more bold decisions. And so maybe it has changed. I do know I have a boy and a girl. I have a son and a daughter. And I was very cognizant of the fact that like my son was a little bit more interested in investing. And so I started teaching my kids about investing when they were very young. And I could totally tell my daughter wasn't really interested that much. But every time, and when they were younger, this is another thing that I should probably share with your listeners. When they were younger, I didn't invest. Well, I did invest into ETFs separately without them really knowing what I was investing in. But with them, I invested into stocks of companies that they knew and understood. So Apple, Disney, and so on. And because they could relate, they understood the business and we could discuss it. So if something happened in the news, we could talk about it. And so a lot of times things would happen in the news and my first instinct was to go to my son and talk to him about it because he was more interested in investing. But I was like, no, 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 I'm going to hold off. We're going to have this discussion at the dinner table because I wanted my daughter to be part of it. And, you know, she definitely wasn't as interested, but I think over the years, I mean, she's 16 now, and I can see she's become so money smart and very much aware of, anything when it comes to investing and making money. And so, but it took conscious effort to get to that point.
Yeah, you had to be deliberate about it. Absolutely. And that's again, you can't leave anything to chance. You have to, you know, plan for the things that you want to accomplish. And I know for you it was to bring them both up with, financial literacy and financial knowledge to make empowered decisions when it comes to their money. Now maybe we could wrap this up with one last question for me and from me, and that would be, can you walk us through perhaps a basic activity or an exercise that you do with parents, or that parents can do at home, to teach any kind of investing, or stop, or money related, um, topics.
Yeah. So, I mean, let's stick with, I guess, investing because that's what we're talking about. So,
Yeah.
one of my favorite things to do, and this is something that I did with my own kids, every time they receive some birthday money, when they were little, actually, we would invest all of it. But now that they're older, we invest 50% and the other 50 they get to spend. So the 50% that we invest, we just sit down and we talk about it. And it's kind of like, okay, where would you like to invest this money? When they were younger, again, it was companies that they knew and understood. If they got significant amount of money, then I would only let them invest a small portion of that money into these individual companies. The majority of it did go into ETFs because I really believe in those types of investments.
Huh?
And then I would actually show them. I would show them their portfolio and how well it was performing. And every time they receive the dividend, which is usually like, March, June, October, like end of September, beginning of October, and December, like I would be like, okay, guys, like you received your dividends, let's reinvest them. Let's make sure that you're earning some more money. And we constantly had conversations about it. I really think it's important to talk about investing. Like it's just something that we do. We're investors. It's kind of like brushing our teeth, right? We all brush our teeth. Well, we're all investors, so it's the same thing.
Now, you mentioned dividends, which leads me to probably our final question, which is, so within the ETFs, you have individual stocks then paying off dividends, even though they're part of this ETF, or were those coming from the individually picked company stocks?
They are coming from the companies that are part of the ETFs. So our VOO, for example, it has a lot of growth companies. Like, as I said, Amazon and Meta. Like, for example, Amazon doesn't pay dividends, but there are other companies within the 500.
Do you know what a dividend is?
No.
So
Okay,
maybe.
yeah. So let me explain. Yeah. So think of it as a lemonade stand. Let's say you start a lemonade stand and you're doing really well and now you want to open up another location or you need money to buy more pitchers and lemon and whatnot. So your mom invests into this for you. So your mom is an investor. Now she's a part owner of your lemonade stand. She gives you this money, you buy more pitchers, you also open up another location, hire a friend, whatever. Now, let's say you're making amazing money, like you actually have a profit. Some of that profit you can reinvest back into the business, which companies that are growing, like Amazon, that's what they do. Or you can actually give some of that back to the investors. When you give that back to the investors, to your mom, that's a dividend.
Yeah. Oh, in real estate, we call it distributing. Net operating income. If there's excess above, the working capital for the property to operate, a rental, we can sometimes choose to distribute those or keep them in reserve in case something breaks down in the house and you need, repairs and so on and so forth. But even after, anticipating reserves for those unexpected, repairs that
You
might
feel
be
like
needed,
you have
you
more.
can have a little excess, and we call it distributing to our investors, distribution. But here it is it's called a dividend, which is a distribution as well. In a way, it's distributing.
So would you be buying in the lemonade stand, like if you pay back mom, the investor, um, would that be buying back some of your company or what?
Not with dividends. So that would be completely different where you would actually buy some of her shares. Yeah, like if you wanted to resume the full ownership of your own company, like and buy some of her shares, that would be something different. But dividend is essentially you just uh saying, thank you, mom, for believing in me and investing in my business, or thank you for being an investor. Here's some of the profits. So not only as an investor in stock market, you can earn money in two ways. One of them is from these dividends, and another one is when the share price increases.
Yeah.
So as your lemonade stand, you start getting these other locations and more employees, and everybody starts to know about this amazing lemonade stand that you have. Your brand reputation is better, and so your company is making money, and like if it's valued more, so your share price will increase. And so if your mom wants to make even more money, she can sell some of her shares for higher price than what she bought them at. And then she can get more money that way.
You can also, which is a little bit more, I would say, advanced, but you can also borrow against your stock,
Yeah.
the
I do
equity
know
that
that.
you have in your stock, kind of like you can borrow against the equity that you have in a home.
Yes, you don't
Yeah.
technically.
Yeah.
Yeah.
So there's those things that
I do.
are possible as well.
Yeah.
They're completely different, underlying asset, but very similar things that can be done. Just like we do options in the stock market, we do options in real estate as well. So I guess we call them just real options, or I mean they're real over there as well, but it's paper in a company, ownership in a company versus an actual physical location or a building,
Yeah.
and so on. If anyone listening is excited to teach their kids about investing in ETFs, which I'm actually going to look into it now. You've inspired me. Where could we learn more about you? I know you have, at teach.kids.money is your Instagram account, but where else can we go and learn more about what you do or connect?
Yeah. So if you want, actually, the best thing for people to learn more about ETFs, I have this like super short PDF document that I share with everybody. It's like my favorite cheat sheet. What I can do, I can send you the link for it, and you can share it with your audience, and then they can just click on it and download it and get more information that way. And then, once they have that, then they'll have some of my contact information because they'll receive an email, and then they can ask me questions. I'm happy to answer them.
Absolutely. Well, thank you so very much. I definitely learned a little bit more about all things stock. Like we
Yeah,
said
me
earlier,
too.
we are very real estate heavy, and so I didn't know a whole lot about ETFs. And like I said, I'm inspired to go and roll up my sleeves and get a little dirty there. And because we have now a brokerage account to
Yeah,
go
we
and spend
do.
a little bit of my, well, not spend, but invest some of that money and see it grow and watch it grow. And I love that idea about the compounding calculator, because this could really help us right now make decisions, even in choices of schools, to see the difference in what we would be spending per year in each of the schools. And I'm like, what if we didn't spend that? One school, I don't know, I'm coming up with an idea. If one school is $20,000 less than the other, per year, what will those 20,000 translate into, if they would be compounding at X, for example, at the 10% that you mentioned that your ETF is growing at. And so it'll help us make great decisions. So thank you so much, Maya. It's been a pleasure. Thank you for having us and for making the time to be with us and pour into Sophia.
For sure. Thank you both for having me on your podcast, and enjoy your day. Bye.